So the business was actually founded in 1926. First off, I'm just going to go on the record, we are husband and wife, and we are not divorced, and this does work, so yes. The business was actually started by Jennifer's grandfather in 1926. Jennifer's the third generation owner. She owns the side that does property and casualty insurance. What that means, auto, home, commercial insurance, things like that. And then about 1999, 2000, I started up a separate branch of the company. We originally started doing all forms of life insurance, but it's primarily on the health insurance side. So over the last 6 or 7 years, we've morphed the benefit side into doing a lot of work with a lot of tech companies. So I'm an advisor over at the DMZ. Most of you probably know the Digital Media Zone. Yep, seeing a lot of heads nodding yes. Work with a lot of companies there and a lot of companies in the space, well-known companies who graduated from the DMZ, like 500 Pixels and Figure One, and I've got a few companies up on the screen there. And we also have a commercial program in place for companies at the DMZ. So when they're actually moving in there, they need to get the minimum amount of commercial insurance in place. We can actually get that in place for about $500. So that's a quick little thing about who we are, where we're coming from. She mentioned as well, we're Toronto-based out in Scarborough, and we've got about 18 people working for us. So tonight, the way this is going to work, Jennifer's going to first talk about the commercial insurance side. So she's going to talk about your regular commercial general liability insurance. She's going to talk about directors and officers, errors and omissions, and she's going to talk about cyber risk. And she's also going to give you a lot of really interesting claims, actual claims that have happened in Canada and the US over the last couple of years that show how much money's paid out. You think, oh, even with my small little company, there's not a risk. Wrong. There's actually a huge risk involved. So she's going to give you some claims experience, claims examples that have happened. And then after that, I'm going to talk about the health insurance. Things you want to look for, maybe not do, things you want to do. That will be the last third of the presentation. The first 2/3 are going to be Jennifer's. So let me turn the floor over to Jennifer, and she can talk to you about the different types of commercial insurance and what each type covers. And again, hands up if you have any questions.
Well, good evening, everybody. First off, congratulations for coming out on a Monday night. You could have done anything tonight, and you came out to hear about insurance. Insurance is probably one of the most important decisions you're going to make. It's expensive, and insurance can be a grudge purchase, but you will be so grateful that you have an insurance policy to defend you and to indemnify you should you be sued. Again, the business insurance, it could be one of the largest assets you have when you get to my age or into your 60s. Your business will be more valuable than your home, hopefully. And lawsuits can be the end of your business. And so it's an extremely important purchase that you make. It's also important that you have a relationship with your insurance provider. I imagine most of you may have had some experience buying car insurance and maybe some tenants or condo insurance, but don't really have a relationship with any insurance expert. That's something you really must do. Find somebody that you have a trust factor with, that you trust, you feel that they're honest, have integrity, and that they're going to give you advice that's best for you. We're going to start talking about commercial general liability insurance. This is a basic liability policy. It's something that you will be starting out in looking at. Chris mentioned that we are experts and providers of insurance for those tech companies who are in the DMZ, and certainly tech startup spaces will want to see you carry some basic CGL liability policies. Certainly at the time when you go to lease your own spot, your landlord won't give you a key unless you have commercial general liability insurance. From an underwriter's perspective, underwriters take a look at a broker like myself. A broker, I'm an entrepreneur just like you are, and I'm contracted with several different insurance companies. And when I send your request for liability insurance to the insurance companies, underwriters will take a look at certain risks. And they take a look at 4 different things, and these 4 different things comprise a basic CGL policy. They take a look at the premises you're occupying, the operations of your business, the product that you've designed or developed or are involved with, and your completed operations liability. This is a basic underwriter's thumb sketch for how they underwrite each risk, and all of this language is in a CGL policy. A CGL policy defends and indemnifies you for allegations of negligence, and it could be bodily injury losses or property damage claims. And now you're saying, well, how does this affect me? Premises liability, most of the claims that we see for a premises are slip and fall claims. Maybe not a shock, but we find whenever the economy takes a dip, the slip and fall claims go on the rise. And insurance companies hate them. They're hard to defend, and often they end up just settling to get the claim settled. So if somebody slips and falls because of your negligence, you may very well be sued for bodily injury. If you're occupying a space in a tech startup, and if you or one of your employees have left a wire, and somebody comes along and trips on it, and they hurt their back or they break a bone, you could receive a statement of claim suing you for a slip and fall loss. Another reason your landlord or a tech space would like for you to have CGL is the damage that you could cause to the space that's under your care, custody, and control. And if you say you were to, accidentally singe something or damage the property that's not owned by you, you could see yourself involved in a claim. There will be a professional liability exclusion on this CGL policy as tech companies. We will come back to this, and there's different types of professional liability that we're going to talk about tonight, but I wanted to bring to your attention on a CGL policy, there will be a professional liability exclusion on your liability policy. The other aspect of CGL is the products and completed ops, which I mentioned earlier. Again, why would you may be asking yourselves, why would I need this? If a product that you've designed or have been involved with anywhere on the genesis of that product being designed, manufactured, imported, retailed, or wholesaled, if it causes bodily injury to a third party, you may be opening yourself to be named in a statement of claim. And again, it's going to have a professional liability exclusion. There are other sub-coverages on a CGL policy that I wanted to talk to you tonight that are going to be important for you. As business owners, you not only have to take care of yourself and the space that you're leasing, but you also have to make sure that you're covered if a claim comes from your own employees. If your own employee is hurt while they are in your employ, and it's during the normal course of their business, you could find yourself sued by your own employee, and that's called employer's liability. We highly recommend that you have this extension added onto your CGL policy. It won't automatically be there, so it's something that you should keep in mind. As soon as you start hiring people, this is something you want to talk to your insurance provider about adding on. It's very inexpensive, and it's important for you to have. One of the reasons I've put the bullet point there with the WSIB Chris will be speaking a little bit about the WSIB alternative, I believe, later on tonight, maybe a bit.
Okay.
We have been asked by several tech companies that we insure that they're waiting for funding and from government agencies, and one of the precursors to them getting that funding is for them to have WSIB. Well, we don't sell WSIB, not through the broker channel, but we often can get the requirement fulfilled by adding the employer's liability coverage on the CGL policy. So I wanted to throw that in there. If you do hear that you need that, it can be a pretty simple fix. The non-owned liability, again, it has to be added onto your CGL policy. Not only are you responsible for employees while they're sitting in your office, but you are also responsible for them if they are driving as part of for you. A good example would be if you have an employee going and doing your deposits for you. Anything during the normal course of your business, if they're driving for you, we would highly recommend you get non-owned auto liability. It is not automatically covered. You need to get the coverage added on to your CGL policy. Tenants' legal liability. This is the coverage that I mentioned earlier about your negligence for property damage of a unit that's under your care, custody, and control. And it's often a lease requirement. The two other items I wanted to mention as far as might be interesting to you, there's an advertising liability coverage that is, it's a trademark infringement. It would be a good cover to get, and the personal injury is the defamation of your character, libel and slander coverage. And so if you've been caught talking badly about one of your competitors, you could find yourself involved in defending yourself on that too. And if you have insurance, then the insurance company will defend you. It's highly recommended that you have your broker take a look at your lease agreement. Your lease agreement should be provided to you when you're looking at spaces, and your landlord may give you some ideas as to what you need to have covered. And it's good for you to show, there will be insurance language about what you need, the types of liability limits that you need. Again, back to this professional liability exclusion. What is professional liability and why is it excluded for tech companies? There is a professional liability exclusion on all CGL policies. So any business that's considered a professional, an insurance broker is a great example. As an insurance broker, I have professional designations. I'm expected to give you professional advice. People come to insurance brokers wanting recommendations on coverage, adequacy of coverage, and they expect that I'm going to do what I say I'm going to do, like substitute the right vehicle or put the right coverage on. If I have failed to do my professional, my being a professional and not giving you the coverage that you expected, or if I have, but you even found yourself out of not covered properly, you could sue me for professional liability, and I would need to have my own professional liability insurance. The same goes with you. As a startup and a tech company, you would be expected to have E&O insurance as well. As soon as you are at the point that you have clients and contractually they could be imposing on you to have E&O insurance, then it's really time for you to do that by. What is professional liability? I gave you a great example of me as an insurance broker, but the definition, financial loss of a third party based on your professional expertise and coverage is not covered under a CGL. In order to obtain insurance for this, you must purchase a professional liability or errors and omissions liability policy. Before we go on to professional liability, I want to talk to you about certificates of insurance. As an entrepreneur and as you grow in your entrepreneur life, you will be asked for certificates of insurance. And what is that? It's really just proof of insurance. The insurance companies all use a form that's been approved by the standards. There's a regulatory body that oversees standards for insurance forms. And it's a very simple thing for an insurance broker to put together, but you do have to have, of course, the insurance in place. And be cognizant as well if third parties are asking to be named on your insurance policy, and be prepared to talk to your broker if you've received requests for this, that you can explain why they wanted to be added. Property. I can't speak about insurance without talking about property coverage. What we're seeing is tech startups don't have a lot of property insurance that they want us to cover. As the tech company grows, then the property insurance needs do grow. It's really up to each individual business. Mostly tech companies have laptops, they have computers, and some of them want it insured and some of them really don't want to pay for it. It's just cheaper for them to replace it themselves. But I think it's important that we do go over some property insurance. It's an important thing. So property insurance, it covers generally for fire, theft. If sometimes a policy will cover for disappearance. It's good coverage to have. Building equipment and stock, that's really the basics of what an insurance policy covers. If you're a building owner, we are going to ask you questions about the building, square footage, construction, how it's occupied, how it's alarmed, and then we can help assist what the replacement cost of that building is going to be. And then you have to let a broker know if you want equipment insured or stock insured. Don't forget your tenants' improvements. We've just had an office renovation done in our office, and some people forget about if they've improved their own units, they're likely responsible for replacing it if there's a fire or if there's an insured peril. They're responsible for replacing it. Replacement cost is actually that. It's replacing your property old for new. It's the best type of insurance you can get versus actual cash value, and it's something that we would definitely recommend. Stated amount versus co-insurance. Co-insurance is a very clever insurance language that insurance companies add on to every single commercial policy. And what it does is it makes sure that if you're not insured to value, that they're not going to pay out more than you've insured it for. So say you've decided you have an office space and you have $100,000 of contents that you should have insured it. But you think, I'm not going to insure $100,000. The likelihood of $100,000 being destroyed in a fire is slim to none. I'm only going to insure $50,000 of it. And you've paid for that coverage and you've had a claim. Even if the claim is for a partial loss, say there's just been a little fire, there's just been a small theft, somebody's come in and only stolen a couple of items, the insurance company will impose a co-insurance penalty. There's an equation that they do, and they're going to make sure they're not going to pay out $50,000 if you should have insured it for $100,000. Your way around that is to get a stated amount coinsurance added onto your policy. Again, you can work with your broker on this. You have to sign a statement of values, and it's more like an affidavit promising to the insurance company that you've insured everything to value, and that way the insurance companies will waive the coinsurance penalty. Crime. Employees. Employee theft is a really, it's a common problem. In fact, we have had 2 of our very large commercial companies, clients this year, and they have had some horrendous problems. One of our commercial clients had their CFO take off with $300,000. We had another one of our clients, his nephew came in and stole the safe that had $80,000 in it. So employee theft is something that we never want to think that's going to happen, but it happens. And you can buy insurance for it. The insurance company will want to know that you have risk management in place, that you have a handle on your financials, that you know money's coming in and out of your company, and they'll want to see, or it would go in your favor if you had more than one signing authority on your banking account, and that you're reconciling your own bank statements and your own cash flow, that you're doing it personally. Those are good risk management tools, but at the end of the day, there's still an exposure. Both of these companies that I'm thinking of, that we have as clients, it impacted their business severely, and neither of them had limits that their losses were for. So the insurance policy only covered them up to about $10,000. If you want more coverage, there is more coverage available. Talk to your insurance professional. Basically, you can buy up to about $50,000 of employee dishonesty coverage on a basic policy. If you want limits higher than that, there are insurance companies out there that will do limits up to, we have a client that has up to $1 million. Yeah. Business interruption, it's probably one of the most misunderstood coverages in insurance. When you suffer a fire loss, as an example, your business is going to be down for a period of time. There's different types of business interruption coverage you can buy. The most limited business interruption coverage you can buy is called extra expense, and it literally will really only pay you to kind of move if you are pretty mobile in where you want to work from. Then this may all the coverage you need. It's called extra expense. Most of our clients have profits coverage or actual loss sustained. It indemnifies you for your standing charges. You will continue to have expenses as a tenant and as a business owner. You will continue to have rent. You will continue to have salary and payroll. You will continue to have perhaps utilities or fees that you have to continue to pay out. You can buy insurance for this. Work carefully, especially as you grow, and you would want to work with your insurance broker. Picking limits is very important. Remember that old co-insurance penalty? That goes for your business interruption as well. And it's a coverage that if you're underinsured on, there will be a co-insurance penalty. Just very quickly, we had a restaurant client, and water has been a real issue for the insurance companies. Water is the new fire. water, water, water. And one of our restaurant clients who, it was a building. We insured the building and we insured the contents and we insured the business interruption. This location had a very, very bad sewer backup, meaning that the sewers actually backed up. The restaurant sat low on a grade and they had 6 feet of sewage sitting in their restaurant. The insurance company went in and the business interruption side of the loss was almost double what the property damage loss was. So the insurance company replaced all of the contents, they fixed the building. The loss on the property side was about $750,000. The business interruption side of it was over $1 million. This business owner wanted to pay payroll, continuing payroll, and unfortunately there was a co-insurance issue. But it can be significant business interruption losses. There is a business interruption worksheet that you can work out, or your finance person, to figure out what your monthly expenses are, and it's certainly not insurmountable, but it's a coverage you really need to be careful in buying and make sure that you buy enough. Equipment breakdown, very quickly, it's coverage we recommend on all clients that have property coverage, and it covers for damage caused by power surge, electrical brownout, and equipment breakdown cover. Errors and omissions, we also call this liability E&O. If you are a professional, there is a professional liability exclusion on your CGL policy, so this is coverage you definitely need to investigate. As soon as you hire your first client, I believe you should be buying E&O coverage. It insures for financial loss of a third party arising out of your alleged error or omission. You can be sued for anything, and so an E&O policy will not only pay for indemnity but also your defense costs. Your defense costs can sometimes cost more than the actual claim settlement. So it's something that you really need to have in place. E&O insurance is a claims-made policy. So there's going to be like a race. You know, in a race you get a starting line and a finishing line. Claims-made policies have clear start and finish. There will be a retroactive date or a continuity date on an E&O policy. If you were to buy an E&O policy today, there would be a retroactive date on that policy of January the 18th. Today's January the 18th. If you buy the insurance policy today and you receive a statement of claim that says it was something that you gave them advice on back in December, this policy isn't going to cover you because it has a start date of January 18th, 2016. It's not going to cover any prior claims. That's why it's so important that as soon as you have your first client, get some E&O insurance. Because once the start date is written in stone, no matter who you buy your insurance policy from, that retroactive date is in stone, and you want to start there. If you buy other businesses, you want to add them onto your E&O policy, and work with your insurance professional on those dates. Those dates are critical. Claims-made policies are tricky, and you want to work with a broker that's very familiar with retroactive dates. Typical liability limits are 1, 2, and 5 million. All of your professional services should be clearly defined on your policy. And often your CGL insurance companies, once they find out about your professional services, and if they find out you do have clients, they often won't give you a CGL liability policy without an E&O. They want to sell it to you in tandem, so there's no gray area that you won't be covered. The insurance company doesn't want to pick up coverages that they didn't intend to cover. If you have both, then there's more certainty that there's going to be coverage in place for you. There will be applications that would be sent if you were to call an insurance broker. They would send you an application to fill out, and it's so important that you include all of your professional services on that application, because they will always come back to that application should there be an issue with coverage. Okay, an E&O lawsuit must be defended against, even if the suit is unfounded and groundless. You can be sued for anything, and it's important that the defense costs can add up, and we have some claims examples we'll go over. As it can be difficult to determine which component part causes a product failure, all part providers in the supply and distribution chain may be sued. Typically, an E&O policy will have worldwide coverage, but again, E&O policies are not all tailored and made the same by insurance companies. Make sure you talk to your broker about that. And we've already talked about claims made and retroactive dates. This is a terrific claims example we've pulled out for you. This is an American claim example, if I'm not mistaken. A company developed risk modeling software. A client of theirs purchased the software and relied on it to make financial decisions. Following the client's financial collapse and bankruptcy, it sued the software developer for providing inadequate software that it relied on making decisions that lead to its collapse. The client was sued, and this is the outcome of the claim. The defense costs were over $1 million. The indemnity that the insurance company paid out was $3.8 million, and the total loss for the insurance company, hopefully they had a $5 million liability limit. I don't know if they did or not, but the total cost of that one claim was almost $5 million. So we're not fear mongers. It happens, and if you have your sign out for business, this is what can happen. This is another claims example. A software company developed IT software to manage an enterprise labor force and integrate it with the client's HR and payroll systems. The software company fell behind in delivering the work, resulting in missed milestones and non-functioning project modules. The software company contended that the client repeatedly changed the size and scope of the project. The client fired the software company and filed a lawsuit seeking to recover the costs of hiring a new consultant and lost profits due to the disruption. The defense costs were over $500,000. The indemnity was $2.2 million, and the total cost of that was $2.7 million. I think this is a final E&O claim example tonight. A software company developed websites and e-commerce platforms. After they were hired to develop a client's website, the client alleged that the software company failed to meet the required project milestones, misrepresented its capabilities, and supplied personnel not capable of carrying out the project. The software company contended the client failed to identify what specific work it wanted done and repeatedly altered the project specifications. A jury trial resulted in a verdict of $608,402 plus prejudgment interest and attorney fees. Following verdict, the case was appealed and then settled for $456,302, including uninsured amounts. So that was the outcome of claim number 3. The defense costs were $1.7 million. The indemnity was only $217,000, and so most of that claim was spent in defending it. Just before we go on to D&O liability, or directors and officers liability, we often get asked by companies about extending E&O. Who does E&O liability insure? The E&O liability, if you set the policy up properly, it would insure your business, it would insure you, and it would insure your employees. If you have independent subcontractors and you want them covered under your own E&O policy, the insurance companies will often want to see that that contractor is working only for you. If they are working for many, many other clients, why would you want to open up your liability exposure to them? So if they are working for you, that would be something that I would recommend, that your contractors are working only for you, and if they are, you could likely get them added onto your own E&O policy. I would say 10 years ago, we would see directors and officers liability policies. Normally it was for nonprofit businesses. Nonprofits had to buy D&O liability, and that's been going on since the late 70s, early 80s. Then the labor unions started to buy directors and officers liability. In the last 7 to 10 years, we have seen a huge uptake on businesses buying directors and officers liability. Because I'm a family-owned business, I would see my parents. My parents were the previous owners of our company, and my mom and dad had to split up the home ownership because my dad was always worried about being sued. And so they ended up putting our home in my mom's name. And that was done so much in companies and corporations in the 80s and 90s. It seems nowadays businesses buy directors and officers liability. I know not everybody here are tech companies or tech startups, but it seems that the tech companies, we do ensure that investors are insisting on tech companies buying directors and officers liability. Directors and officers liability covers for the D&Os of the board, and in most cases, full entity coverage. And it covers for alleged wrongful acts of its board and employees. You have a duty of integrity, a duty of trust. As a business owner, there are many duties that you have to act in utmost good faith. Wrongful acts is a very broad definition, and on directors and officers liability policies, usually exclusions define coverage. In most directors and officers policies, and as an example, breach of contract is not covered. Also, employment practices liability. You could be, or one of your employees, it could come to your attention that there are some harassment issues in your company, or if there's a wrongful dismissal issue, if you have terminated an employee, they could very well come and sue you for wrongful dismissal. So employment practices liability is basically where we see most of the claims. Probably 90% of D&O claims arise from issues around employment practices liability. Again, the policy should defend you and pay for indemnity. Not all D&O policies are written the same. There are many, many insurance companies out there who do D&O liability, and it's amazing to me how different the coverage is on each D&O policy. So again, not all brokers know D&O liability well. So work with a broker that knows D&O liability well and can show you the differences, and you can make a decision from there.
Just further to Jennifer's point, it's not just tech companies that are looking for this. Anybody who's going to be looking to invest money in your company is going to want to have D&O before they actually assume a place on your board of directors. Give you an example. There's a well-known Canadian startup out of Montreal called Frank and Oak. Frank and Oak has raised several rounds of funding. And before the investors would actually assume a place on their board, before they'd actually invest money in the company, they had to have the D&O coverage in place to protect them. So it's not just specific to one industry.
No.
It's for anyone who's looking to protect themselves and their board who invest money in them, this is what you need.
Terrific, thanks, Chris. So we did bring some claims examples. D&O liability can be a difficult coverage to get your head around, but it is important. And here's our first claims example. The vice president of a manufacturer determined that diversification into a different product line presented tremendous sales potential. Instead of presenting the opportunity to his company, the VP informed his brother, who formed a new company to manufacture that product. On behalf of the company, a shareholder sued the VP, alleging that he wrongfully took advantage of an opportunity belonging to the corporation. The insurance company did defend, and the case settled for $2.5 million. He did not act a duty of good faith, a duty of trust, and there was cause for a suit, so the claim came. Claim number 2. The employee of a small private business convinced the board of directors that he was qualified to step into the role of president and was appointed. Under his leadership, the company's financial position substantially weakened. On behalf of the company, a shareholder sued the board of directors, alleging that it used poor judgment and did not act in the best interest of the company when it appointed a new president. The case was settled for $1.5 million. The legal costs were $300,000 and the total claim was $1.8 million. I think this is our last topic before I hand over the reins to Chris. Cyber risk liability. It has really, insurance can be kind of boring, and we don't have a lot of game changers in our industry. And I have to say, in the last 10 years, this coverage is a real game changer. Hackers have really changed the game. Employee mistakes have really changed the game. And the right to privacy. The public really do have a right to privacy, and you have legal obligations if that privacy has been breached. Every single business out there has an exposure. Some businesses keep credit card information. Some businesses keep health background. Some businesses keep information like driving records, like myself. It's amazing the data that we collect and that we have responsibility over. None of the insurance policies we've talked to up until now cover cyber risk. The insurance companies have systematically excluded privacy breach incidents off any liability policies. There are no two cyber policies alike. Some insurance companies only offer a bit of first-party coverage, and some offer a full cyber risk policy that covers you, covers liability from third parties, covers your business interruption. So if you're down, if you've been hacked and you're down and out of not able to work for weeks on end. So really, I just wanted to bring it to your attention that it's an emerging game changer type coverage. It might be of significant interest to you, and there are insurance companies that are out there that are covering it. There are PR issues. There are legal requirements. You may have to contact your entire client base to let them know there's been a privacy breach. There's a cost to that. Are you going to hire a PR firm to do that, or are you going to do it yourselves? There's a loss of your reputation. Your companies each have a reputation, and are you going to lose business because of the breach? And we've talked about business interruption. A December 2014 report found that the average U.S. cyber breach claim payout to be $733,000. The average claim for a large company was $2.9 million US. The healthcare sector has a huge exposure to this, and we've put some of those statistics here. The average claim in the healthcare sector was $1.3 million. Data based on 117 claims. There were 117 claims between 2011 and 2013. Of the 111 claims submitted, 85 had reported payouts totaling $62 million US. And we know if this is happening in the US, it will come to Canada. The States is more litigious than Canada, and there are certain states that are more litigious than other states. And that's something to be considered, but it will come to Canada for certain. Here are some more statistics, and the smallest claim payout was $1,000, the largest was $13.7 million. Of $62.3 million in payouts, 48% was spent on crisis management services, 15% on legal costs, legal defense, 10% on legal settlements, 10% on regulatory defense, and 6% on regulatory fines. And lastly, 11% on payment card information fines. And there's some more statistics for you. So a real game changer in my business and in my clients' businesses. So again, have conversations with your insurance provider. Sometimes cyber risk can be added on for a very nominal cost. Some insurance companies will package it with your CGL and E&O policies, and they'll throw some cyber on there. But the bigger and more complex your business is, you may need to do that on a separate policy. So Chris, I want to leave you enough time. Do you have enough time? Okay, good. Okay.
I'm not going to take that long.
Okay. So just some more very interesting statistics. Hackers were the most frequent cause of loss, followed by staff mistakes. Staff, it can happen so easily with email. You know, have you ever sent an email to the wrong, you start typing, and I think I'm spelling Jennifer, and I end up spelling Janice, and all of a sudden Janice has a sensitive email. It can happen that fast. So that's how fast you've opened yourself up to a privacy breach issue. In 32% of claims submitted, there was an insider involvement, and the average number of records lost was 2.4 million. So crisis services could include forensics, and that can be forensic accountants. They are often called in for these types of claims. Legal guidance was $366,797. The average cost for legal settlement was $558,000. And this is a good recent statistic. In May of last year, there was a survey done of just over 1,000 small businesses, and they found that 31% have experienced a cyber attack or attempted cyber attack. It's a pretty frightening statistic. This is from the 2016 Global State of Information Security Survey. In 2015, 38% more security incidents than in 2014. Theft of hard intellectual property increased 56% in 2015. So you can see employees remained the most cited source of compromise. However, incidents attributed to business partners rose 22%. Here's a cyber risk claim number 1. A software developer was hired by a U.S. company to develop and install POS software, point of sale software. The client commenced action against the insured for $1.2 million, alleging that the software didn't work properly, leading to both lost sales and lost customers. The insurance company retained a lawyer to defend the insured. The investigation revealed that the defective software was to blame for the client's loss. A settlement was reached, and the insurance company paid $120,000 in legal costs. Just before we go on to claim number 2, you can see how important we've put a puzzle together here tonight, and you can see that there's often gray areas in lawsuits, and they may list a number of things in a lawsuit. When you receive, if you were to ever receive a statement of claim, which I don't wish for any of us here, but if we do, the allegations could go on for miles. And so how important is it to have all of these liability components so you're covered off everywhere? How devastating would it be? You've paid out premiums of $3,000-4,000 a year. You think you're covered for everything, and then all of a sudden a statement of claim comes in, and it's a cyber risk issue, and your other liability policies won't cover it. So a gray area is a real issue. Cyber risk claim number 2. A software developer sold defective software to a distributor, who in turn sold it to their client. The client sued the distributor for $500,000 for failure to properly design, implement, and install the software, as well as for failure to properly train the client's employees. The distributor then sued the developer for $500,000. The insurance company retained a lawyer to defend the developer. An investigation revealed that the software was in fact defective. A settlement was reached, and the insurance company paid $100,000 in legal costs. Claim number 3. The insured was a value-added reseller of computer equipment, network sales, and installed financial and operational software. The insured sued its client for non-payment of fees. The client then countersued for negligence, alleging that the consulting services were inadequate, the software was deficient, and the consultant misrepresented the capabilities of the software. The benefit of the first dollar defense coverage meant, and I should say no, a first dollar defense means that the deductible doesn't start until the indemnity costs. So they'll defend you at $1, and it's good to get first dollar defense if you can get it. The benefit of the first dollar defense coverage meant that the insured incurred no expense on this successfully defended claim.
So I'm going to go through this. I'm on the fun side of insurance, if you would. When you're starting up your business, you're looking to get your CGL, your E&O, D&O, whatever in place. This is the fun stuff. Where you take care of your staff, where you take care of yourself. Employee benefits coverage. So why offer coverage? Next to salary, employee benefits coverage is probably the most important thing that you can actually do in attracting and retaining staff. There was a survey back in 2010, and they surveyed, I think it was 1,894 people, and they said, what do you think of your employer when they offer benefits? And they said, we're thinking more positively, of the employer when they offer benefits coverage. This was up from 2009. You can see 4 points up over 1 year. And again, following year, this is an annual survey they do, And they interviewed again about 1,850 people in 2011. They said, what would you take? Would you take $10,000 or your benefits coverage? 59% of the people said, we'll take the benefits over the cash. That was up from 2009. They said, what happens if you bumped it up to $20,000? Would you still take the money? And 48% of the people said, we'll take the benefits over the $20,000 because the perception of the value, the coverage, the potential exposure was worth a lot more to them, the peace of mind for their family. So with benefits, it's something you're going to be looking at down the road, not necessarily to start off with, but there's 3 different types of plans you can look at. Traditional employee benefits coverage, you've probably all had that either on your own or through your parents at some point, where you have a drug card coverage, a drug card provided to you. There's also something called a healthcare spending account, acronym is an HSA or an HCSA, and a private health services plan. When you're starting up, the one you're going to see the most of is either a healthcare spending account or PHSP, the private health services plan. As you get larger, as you have more staff on board, then you can actually look into a benefits plan. Quickly talk about what's in each one, pros and cons of each. So with the traditional benefits plan, that's where you get the life insurance, the accidental death and dismemberment coverage. If something happens to you, you lose a finger, an eye, an ear, a toe, or if there's an accidental death, you're hit by a streetcar while crossing Dundas Street, that's an accidental death. That's where you also have the health insurance for prescription drugs, for paramedicals like physiotherapy, massage, where you have your travel insurance, where you have your semi-private hospital, your vision coverage. There's dental coverage, which we all know about, cleanings, fillings, scalings, x-rays, root canals. Disability coverage for if you can't work, it's going to cover you. And it may include something you're seeing a lot more of these days, something called an Employee Assistance Program or an EAP. It's an outlet for your staff if they're having any issues at home or at work to get some counseling, whether it be over the phone, whether it be face-to-face. There's a lot more awareness going on now. You see the Bell Let's Talk campaigns, which are actually happening around this time of year. There's a lot more awareness that's actually going on with mental health. And that's where employee assistance programs come in. Somebody's feeling pressured at work. Maybe they don't like a coworker or their boss. Maybe they have a legal issue or an accounting issue at home. That's where the EAP would actually kick in. The healthcare spending account is something that when you get off the ground, this is probably the first thing you're going to look at. It works like a bank account. So what happens is that each employee every month is going to have a credit you're going to provide them. It could be $50 or $100 or $200, and they can submit their medical claims, their prescription drugs, their dental against what credit they've actually built up on their spending account. So with the spending account, you determine how much money you want to give your employees. The perception is that you're giving them a lot. It doesn't necessarily have to be that much. It could be $50 a month. It could be $75. It could even be as low as $25. But you're giving them the peace of mind that you're actually taking care of them. So the amount that you give them is locked in for 2 years. So be very careful when you're setting up a spending account that you determine this amount, I can sustain this. You can't revise it all. And that's a CRA guideline. Now, there's an interesting thing. When the employee leaves the company, the money's not actually following them. The credit actually stays with the company. Credits can be carried forward for up to 2 years. So if you're giving someone $50 a month, they've built up a credit of $600 over the course of 1 year. The maximum they can build up is $1,200 in that scenario. You can't carry forward anything more than 2 years, and that is a CRA guideline. Medical expenses, again defined by the CRA, what you can put through. Dental, drugs, semi-private hospital, vision, physiotherapy, things like that. The cool thing about a spending account is that if you're giving them, say, $50 a month, in month 2, someone cannot actually submit a $500 claim. It's only when they've built up enough credit can they actually submit a claim equal to that amount. With a spending account, it does not include life, accidental death and dismemberment, or disability. The other option I talked about at the beginning was a private health services plan. It works a lot like a spending account in that you're giving everyone a credit, but with a spending account, you're only paying the money as claims are made. So if you have 2 staff, including yourself, and no one has any claims for the first 2 months, you're not actually sending any money to the company that's adjudicating the claims. With the health services plan, you are cutting that check every month, regardless of whether claims are made. So factor that into your cash flow when you're actually determining this. There is no carry forward with a PHSP, but the big thing is it's dependent, it's tied into the employee. So let's say someone's with you, you're giving them $100 a month, they're with you for a year. They've built up $1,200 credit, they leave the company. That money follows them. They could go work for the competitor down the street. He's got your $1,200 to actually submit claims against. Make sense so far? Not many people do. Very, very few. Most companies, the question was why would anybody choose that? It's generally for the self-employed because they can carry forward as much as they want. It's not limited to 2 years. But once you get that first employee, most people opt for a spending account. They don't opt for the services plan. So again, they're the same expenses, same medical expenses that are defined by the CRA. You can actually put more through a spending account and a health services plan than you can through a regular benefits plan. The list is exhaustive. It's 12 pages long, but there's some really interesting things in there. For example, if you actually have an elderly parent and you're paying to take care of them, you could actually put the medical expenses through a healthcare HCSA or a PHSP. So there is a lot more flexibility associated with it. And like the spending account, it doesn't include life, it doesn't include accidental death and dismemberment, and it doesn't include disability. So that pizza smells really good. That's the gist, that's the basics of a healthcare spending account and a private health services plan, a PHSP. Very, very top level talk. So a couple things here. I mentioned this just if you were looking for, I know not everyone here is in the tech space, but this is kind of applicable for if your demographics, if your staff are below 35, say, these are the hot topics that people want to see covered. Vision, dental, and paramedical coverage, and especially chiropractors and massage, and the last 20 months, acupuncture. Acupuncture has seen a huge uptake since really, I guess, the beginning of 2014. Before that, it was off the radar, but now, huge uptake. So if you're going to do something and you want to, if you're, for example, you've got a company with 5 staff and you want to focus in on certain areas based on your demographics, if you're attracting younger staff, I would focus in on the vision, the dental, and the massage, and the acupuncture, and the chiropractor. And as mentioned, the second point, you talked about that, the tax deduction to the business. With the traditional benefits plans, a lot of companies actually split the premiums 50-50. So the employer, as the employer is paying 50%, the staff are paying 50%. Contractually, with all the insurance companies except for 2, they say as the employer you have to pay at least 50%. Great West and a small company from out east actually have lower minimum requirements. Great West actually says you only have to pay 33% as the employer, and a company out of Moncton called Assumption Life has a minimum requirement of 25%. So, but it's good to have people paying a little bit of premium, they have some skin in the game. I don't have any claim examples, but I do want to share a couple things with you. We're seeing a lot of paramedical abuse, a lot of claims abuse going on. And as an employer, this is something you have to watch out for. I had a client out in the West End, and they had about 110 staff. And they found a place up in Brampton that had 4 paramedicals under one roof. So they had a physiotherapist, a massage therapist, a chiropodist, and there was a 4th one I can't think of right now. And generally speaking, paramedicals, which are those areas I mentioned, run about 25 to 30% of your health claims. Well, this company found a place up in Brampton where you could actually walk in, and depending on the amount of paramedical coverage you had, walk out with a flat screen TV without actually seeing a doctor. So they would actually submit fraudulent claims on your behalf, and depending on the size, depending on the amount of coverage you had, dictated the size of the Sony Bravia that you actually got. There was a couple scenarios up in Markham where surgical stockings were actually surgical stocking abuse, something you don't think about, but somebody actually found a clinic where they would actually submit submit fraudulent claims up to the tune of a couple $100,000. If you've been reading the Toronto Star for the last couple of months, you've been seeing about the TTC and their issues with health claims. They actually found a clinic in North York where a bunch of staff went and actually submitted $4.5 million worth of fraudulent claims through Manulife. So if you do go for the first option, the traditional employee benefits plan, speak to your broker, make sure that they are actually running claims experience reports every quarter. That way, if there's any claims abuse going on, allows you time to actually take corrective measures before it totally messes up your premiums. Because what happens is, after 12 months of claims experience, they figure out what the premiums are going to be for the next year. So a good broker will actually provide you that report every quarter, and you can take corrective measures if need be.